This is part 2 of the Chapter 4 lecture. At the end of part 1, we had completed this trial balance. So for the month of June, transactions had taken place, and we had recorded and posted those transactions. So these accounts have these ending balances. Now, we're still at the end of June, and we need to be able to fully measure all the revenues and expenses. So let's go kind of take a peek or think through some of these accounts, whether either revenues might have been earned or expenses incurred throughout the month of June that we haven't recorded yet. For instance, let's look at this office supplies. This $500, as you may recall, is from purchasing office supplies early on in the month of June. But what do you think has happened to those office supplies by the end of June? Well, some of them have probably been used. So we're going to see where we're going to need to adjust some of this cost out of the asset and move it to an expense account so that we get an accurate measurement of, how many supplies do we actually have on hand and how many of those supplies have been consumed. Let's go to prepaid rent. As you may recall, this was for 3 months rent for the truck, or lease, if you will. So by the end of June, one of those months has been consumed. 1 month has gone by. So again, prepaid rent really isn't $900 at the end of June. We would have consumed part of that. Same thing with the lawnmowers. We would have used those lawnmowers. So we need to recognize the using up of some of the costs of those lawnmowers. And then lastly is this unearned revenue account. Recall, that is an obligation to provide services in the future. And so customers prepaid. We collected money in advance from customers. By the end of June, we would have mowed some of those yards and earned the revenue. So we have 4 accounts that I can just kind of look at and eyeball and recognize, well, things would have happened during the month of June. These are not actually their correct balances for these 4 accounts. So let's go back to our information for the homework for this demo problem and look at how we will adjust these balances to correct them. And just as a review, let me remind you, we've already completed part 1. These are the transactions during the month of June. Now we're in part 2, where we have posted, we have ending balances, and we can see there were 4 accounts that really probably were not accurate, and we need to, quote, adjust them here at the end of the month. So actually, I'm not going to start with A. I'm going to actually start with B. We have unearned revenue that has been earned. So recall, we received cash of $300 from customers for mowing June and July. And when we originally recorded this, let's go to transaction 5. Transaction 5, cash came in, and we created a liability for unearned revenue of $300. Let me keep going a little bit. Okay, so let's look at the unearned revenue account. Our unearned revenue account has $300 in it, right? And that is for 2 months of mowing yards of $300. Well, by the end of June, what should the balance be? Well, if that's for 2 months, we would have mowed June and we still have July left over. So there should be 1 month's left, or $150 balance. So there's $300 in the account, and that's for 2 months. By the end of June, we would have mowed yards for 1 month. So the balance should be $150 at the end. So let's go back and look at, well, how am I going to go from 300 down to 150? What would my journal entry be? Okay, so here we are. Unearned revenue, just as a review, we had $300 in it. We want the balance to be $150. So what's happened is that, if I think of the transactions, we have mowed yards, and which is revenue. So what we delivered, what we gave up, was mowing the yards. And in exchange, we get a reduction of our unearned revenue. So the liability will go down. So the give and take is that we mow these yards, and in exchange, we get a reduction of this liability. So revenue is part of stockholders' equity. That would go up with the credit. And liabilities, debit credit rules go down with debits. So we're going to make an adjusting journal entry debiting the unearned revenue, the liability account, and crediting revenue. And I'll make that B. So we're debiting unearned revenue, which was a liability account, $150, and we're recognizing service revenue. I went over there, didn't I? Okay, so please note, adjusting journal entries are at the end of the accounting period to fully measure. I'm going to go ahead and post this to my accounts. So we had adjusting journal entry B, and tell you what, let me make those in blue so they're a little color coded. So we're posting unearned revenue $150, and we credited revenue $150. So I have a debit to unearned revenue $150, credit revenue $150 down here. So on the unearned revenue, notice I started with $300. We subtract $150, right? It goes up with credits, so $300 minus $150 gives us an ending balance of $150. Okay, let's look at the next one. On C, we have we have $200 of supplies are still on hand. $200 of supplies are still on hand. So let's go back where we purchase office supplies of $500. So if we go to our supplies account, we can see there is a balance of $500, but when we went in and counted those supplies, there's really only $200 left. So there's $500 that we purchased, but now at the end of June, there's only $200 in there. So let's go back and figure out what would that adjusting journal entry be. So let's again kind of take a peek at our office supplies account. It goes up with debits. There's $500 in there now, and there ought to only be $200 in there. So what do we need to do? Well, what's happened here is we had an asset of $500, and we need to move some of those costs over to an expense. So again, what's really going on here is that we have consumed supplies. So that's what we've received. So we have used supplies, consumed the supplies, and that causes our supplies to go down. So if we use something, that is an expense, right? If we use or consume, if we consume something or use it, that's an expense. So we have an expense here, and supplies is an asset. So our asset is going down. Apply our debit credit rule. That would be a credit. And supplies expense reduces retained earnings. If I reduce this side, that's a debit. So I need to reduce this side for the expense. So I'm going to debit supplies expense, and I need to reduce the asset, and that I do that with a credit. So when we go to our adjusting journal entry, I will debit supplies expense and credit the asset office supplies. So I'm going to do the debit first. Debit supplies expense. I'm just going to abbreviate that, EXP. Reduces stockholders' equity, and then I will credit office supplies. credit office supplies, which is an asset, for $300. Okay, so I debit supplies expense and credit office supplies $300. And let's go post that. So we need to set up, we don't have a supplies expense account. So let's set up a supplies expense account. Expenses are debits. And now let's post it. So transaction C was a debit to office supplies expense, $300, and a credit to office supplies, $300. So again, assets go up with debits, so 500 minus 300 gives us a balance of 200. Okay, let's go to D. On D, we had the expiration of the lease. So that was back over here, transaction 7, when we paid $900 for the lease. So let's go to our accounts. Remember, we put that in prepaid rent. That was for 3 months. So there's 3 months of rent in there. That was $300 a month. The balance ought to be for 2 months, so that would be $600, right? The lease for the truck is $300 a month. So 3 months, 300 times 3 months would be $900. We need an ending balance for 2 months. 2 times $300 is $600. So we know the balance ought to be $600. So how do we get it there? So again, I'm just going to abbreviate prepaid rent. Goes up with debits. We have a balance of $900 in there, and that was for 3 months. And by the end, there would really only be July and August that is prepaid. So how do we get it there? Well, what's going on is that we have used the rent, and so the prepaid asset, the prepaid rent will go down. So we're really just doing this. We're taking cost out of an asset and we're moving it to an expense. We're taking cost out of an asset and moving it to an expense. So if I use the rent, that is an expense. Prepaid rent is an asset. Assets go down with credits. So we will credit prepaid rent, the asset. Rent expense decreases retained earnings. Decreases on this side are debits. So we will debit rent expense and credit prepaid rent to make this adjusting entry. So here again, we're going to debit rent expense to decrease stockholders' equity or retained earnings, and credit prepaid rent which is an asset, for $300. So we're going to record the expense and reduce the asset prepaid rent. Let's go post that. We do not have a rent expense account, so let's set one up. Expenses go up with debits. So on D, we debited rent expense $300 and we credited prepaid rent $300. So now we have expensed rent for the month of June. Over here, prepaid rent $900 minus $300 gives us an ending balance of $600. So for the $900 paid, we've used $300 the month of June, and $600 is still an asset. Okay, last one. Okay, let's go back and do A, the depreciation for the lawnmowers. So let's go back up. We bought the lawnmowers for $15,000 and we expect to use them for 10 years. And so we can peek ahead. Under assets, we see the lawnmower has a cost, right? We put the original cost of $15,000 in there. So we just want to take some of that cost that's in the asset and move it to an expense. We won't move all of the cost because we haven't consumed all of the cost. So let's see, $15,000 $15,000 over 10 years would be $1,500 a year. So $1,500 annually. But this is only the month of June, so we're going to divide by 12 months to get the amount for June. So $1,500 divided by 12 is $125. $125. Okay, so we've got $125 of expense, and this we're going to call depreciation. Depreciation expense. So we're going to have $125 of cost that we're going to take, from the original $15,000 and move it to depreciation expense. And again, expenses decrease this side, they're debits. Now, this one's a little more complicated because in the other cases, we would always just, reduce the asset itself. And with these long-term assets, we won't do that. I'm going to create another account called accumulated depreciation, and that's the account I'm going to credit. And it's going to have the impact of reducing assets. So I'll show you that here in a minute. So we're going to debit depreciation expense, $125, and we're going to reduce assets by crediting this account called accumulated depreciation. So let's go do that. So on A, we will have depreciation expense of $125. Okay, and that reduces stockholders' equity and or retained earnings. And then we're going to credit an account called accumulated depreciation. Accumulated depreciation. And it's a credit. We know that credits, so accumulated depreciation, and we know that credits reduce assets. And that's going to have the effect. Okay, let's go post this so you can see what's going on. We don't have a depreciation expense account, so let's add that here. So depreciation expense, and I will post the $125 debit. So we have depreciation expense, debit $125. Now under assets, I'm going to add that new account we created called accumulated depreciation. So long account title. Accumulated depreciation, and we're crediting it $125. So we debit depreciation expense, credit this account called accumulated depreciation. Now, accumulated depreciation normally has a credit balance. Even though all the expense accounts have debit balance, accumulated depreciation will always have a credit balance because it is a contra asset account. It's a negative asset account. Contra asset. So notice we did not take the $125 and credit lawnmowers to reduce it directly. We indirectly reduce lawnmowers by creating this accumulated depreciation account. Okay, so we have these ending balances, and I'm going to double rule them now. Cash, let me switch to black ink. Cash, accounts receivable, office supplies I've already double ruled. Same thing with prepaid rent. Lawnmower, $15,000, accumulated depreciation, $125. So we have these ending balances, $150, $700. Now over here, I'll go ahead and double rule common stock, and that's going to be the last one. I'll double rule. Service revenue, I actually need to draw a line and arrive at its new balance, which is going to be $1,400. And I won't double rule it. So 1,400, and then all of these expenses and dividends only have one item. Okay, so I'm going to move now to the next trial balance, which we'll call our adjusted trial balance, but it's going to have these ending balances from each of these accounts in it. Okay, so now we've gone and we can see these adjusted final balances for some of these accounts. So notice a lot of them do not change. We didn't see any change when we got to office supplies. Now it's different because we've consumed part of it. Prepaid rent is different because we've used some of that. The lawnmower is not, but we do have this accumulated depreciation account that I inserted. Unearned revenue went down because we've earned some of that, provided lawn mowing services. And then, hang on a minute. I just discovered an error here. This actually should be $100. So that should be $100, and that does not change this total. This still would be $32,350. So I'm not sure what happened there, but just for clarification, that should be $100. And by the way, I would change it. There we go. Figured out a way to draw. I'm using a little bit different tool with this document I have in front of me. So not as easy to write on. Anyhow, this should be 100, and obviously that will carry over. Service revenue went up because we earned some of this unearned revenue. Okay, and the miscellaneous expense stayed the same, and we have 3 new expenses here. And if I scroll down, here I can see my debits equal my credit. Okay. From the adjusted balances, we will write out our financial statements. So notice I have these listed. We've got our assets, liabilities, and stockholders' equity. So these accounts are going to be used to write out the balance sheet. Here we have revenue minus expenses. These will be used to write out the income statement. So just getting started, just so you know, here's going to be the numbers I will pull when I write out the income statement. So I'm going to use revenue minus these expenses. And then we will solve for net income. Keep in mind right now we have 0 retained earnings. So when I get to retained earnings statement, we'll start with nothing. So I'm going to write out the income statement using these numbers. Then we'll go to the retained earnings statement starting with nothing. And then lastly, I'm going to write the balance sheet out, and that is going to come from these numbers here. Just so you know when I'm plugging in numbers where they come from. Okay? And very particularly, I will want you to notice this idea of the lawnmower and the accumulated depreciation. And we'll point out the debit and the credit and how that will work when we get to reporting it. So let's start with the income statement, go to the retained earnings, and then we'll do the big balance sheet. Okay, so we have Bell Lawns, we have the name of the statement, and this is for the month of June, so we're going to write for month ending, or for month ended, whichever you prefer. And we're covering the month of June, and that month ends on the 30th. So, and I'm forgetting what year. I'll just do 2015 because I don't know if I gave you the year or not. Okay, so again, I'm pulling from my trial balance. We had service revenue, and that balance was $1,400. So I'm going to start with a dollar sign and use whole numbers, $1,400. And then we had our expenses. And I will just list those expenses out. So I put a colon behind that, expenses, and then we had miscellaneous expense. For $200, and I'll put a dollar sign in front of that. Let's see, what else did we have? We had depreciation. So we had depreciation expense of $125. We also had supplies expense of $300. And then rent expense also of $300. And then I'll draw my line and we'll add those up. Expenses total $925. Okay, so I have my dollar sign at the top of each column, and over here now on the far right I have revenue minus expenses, and the difference is going to be net income. $475. And since it's the end of the statement, I'll put a dollar sign there and draw two lines. So I have a dollar sign at the top of each column, and then a dollar sign at the end of the financial statement, and then two lines at the bottom. Okay, so net income, $475. Let's go to our next statement, statement of changes in retained earnings. This also covers a period of time. So for month ended, June 30th. Okay, and so then we had our beginning retained earnings. Recall that was 0. I'm not going to put a dollar sign because that's the first column, first number in the first column. So beginning retained earnings was 0. We talked about that earlier. And then plus, we're going to add in net income. So we'll take this number up here and we plug it in down here. We will subtract, so less dividends. Sorry, I'm getting off my lines here a little. Just should be able to keep it kind of big. Recall dividends, backtrack a little bit. Dividends were $100. And then we will have our ending retained earnings. So 0 plus 475 minus 100 is 375. It's the end of the financial statement, so I draw two lines. Put a dollar sign. So dollar sign at the top and the bottom. Okay, this 375 will go forward to the balance sheet. So when we get there. Okay, we're going to have a classified balance sheet. The balance sheet is at a point in time. So at, or as of, if you prefer that. So at or as of June 30th, 2015. So we're going to start with our assets. And list those out. So we'll start with current. So our first category or classification is current assets. And again, I'm just pulling this from the trial balance. So the short-term assets are cash. Put a dollar sign to start with it. It has a balance of $15,300. And then the next one is accounts receivable. Of $250. Office supplies. And again, I'm just pulling them from the adjusted column of that adjusted trial balance. And then prepaid rent. $600. Draw my line. So all of these accounts will be used, sold, or converted to cash within a year. So these are all the short-term current assets. I add them up, I will get $16,350. And since this is the first number in that column, I'll put a dollar sign by it. So total current assets. Okay, so one category of assets is the current assets. The category for long-term physical assets is property, plant, and equipment. So for long-term physical assets, the category usually is called property, plant, and equipment. Semicolon. Okay, so we had the physical asset was lawnmowers, and the balance in that account is $15,000. That was our original cost. So the original balance is $15,000, and we will subtract from that the account that has a credit balance, accumulated depreciation. I am not going to get that all squeezed in there, so I'll just abbreviate. You really shouldn't abbreviate on these financial statements, but I don't have an option here. So less accumulated depreciation, remember that was $125. That was a credit balance, so it's a negative. Remember, accumulated depreciation is a negative asset. Let's go back and look at those T accounts. So I'm very much looking at the lawnmower and the accumulated depreciation, these two accounts together. We're reporting this $15,000 cost, and then the credit is getting subtracted of $125. So those two get reported together here on the balance sheet. I'll draw a line. That will net to $14,875. And there's usually not a word for it, but I will tell you that $14,875 is referred to as book value. Book value. The accounting records used to be physical books, so really this means the accounting value, which is accounting book value. Okay, those are only two types of assets. So we have current assets, long-term property, plant, and equipment. We'll add those up to arrive at total assets. So add those two together and I'll get $31,225. That's the end of that portion. So I double rule it and put a dollar sign. Okay, the next big heading would be liabilities. Liabilities, we want to break out current. I think that's all we actually have are current liabilities. We don't have any long-term. Current liabilities. So we had unearned revenue. Of $150. Again, it's like we're starting a new section of this financial statement. So I'm going to put a dollar sign at the top. So unearned revenue and then accounts payable. Of $700. So total current liabilities is $850. Again, it's like as if it's at the top of the column, as if we stop with total assets and we start anew, so a dollar sign at the top of each column. Next section, stockholders' equity. Stockholders' equity. Okay, and then we have our two accounts, common stock. Common stock had $30,000 in it. Again, I'm just pulling that from the adjusted trial balance, so $30,000. And then we had retained earnings. The retained earnings I do not pull from the trial balance because I didn't have anything in there. Recall, I'll go back to my statement of changes in retained earnings, and we had this ending balance at June 30th. The ending balance is $375, and I take that forward. $375, add those together, $30,375. So total stockholders' equity, a lot of long words, isn't it? Total stockholders' equity is $30,375. And I want to add liabilities to stockholders' equity. So now I'm going to do total liabilities and stockholders' equity. Get my apostrophe in there. Equity. So I add the 850, the 3375, and I will get 31,225. Double rule it. So I have total assets 31,225 double ruled, total liabilities and stockholders' equity double ruled. Okay, and we will stop. This is the end of part 2, and we'll do the third part in class together.